They just crashed silver on purpose, and I'm going to show you exactly why they did it, who benefits, and what happens next. Because what you're watching right now isn't a normal correction. This is coordinated, this is strategic, and if you don't understand the mechanics behind what just happened, you're going to miss the single biggest setup in the silver market we've seen in years. Today is Monday, February 2, 2026. Silver is trading at $85, but let me show you what just happened. On Thursday, January 29th, silver opened at 114.58 and rallied to 21.57 before closing at $383. Then came Friday, January 30th. Silver opened at 113.91, spiked to 118.59, then absolutely collapsed. The low of the day hit 76.67.67 before closing at 86.33. That's a $40 drop from Thursday's intraday high to Friday's intraday low, a 35% crash in 2 trading sessions. And here's what they're not telling you. Silver didn't just fall, it was taken down. And the people who orchestrated this move aren't trying to exit the market. They're trying to get in before the real breakout begins. Let me show you the evidence. On January 30th, 2026, the COMEX reported a massive one-day withdrawal of physical silver from registered vaults, over 3 million ounces pulled in a single day. That's not profit-taking. That's panic buying disguised as vault transfers. Because when price drops and physical disappears at the same time, that tells you one thing. The paper market and the physical market are no longer aligned. Someone is using paper contracts to suppress price while simultaneously accumulating metal. And that divergence is about to create the most violent short squeeze we've ever seen. Here's why this matters. Right now, the COMEX silver inventory has been declining for 9 consecutive months. We're sitting at the lowest registered silver level since 2016. That's 10 years of drawdown. And during that same period, industrial demand for silver has exploded. Photovoltaic solar panel production alone consumed over 161 million ounces of silver in 2025. That number is projected to hit 210 million ounces this year, and it's not slowing down. Every single solar panel requires approximately 20 grams of silver. There is no substitute. There's no alternative material that matches silver's conductivity and efficiency at scale. So when you see price dropping while physical inventory vanishes, you're not watching a bear market. You're watching the setup phase of a supply crisis. Now let me show you who's behind this move and why they need the price lower right now. The largest accumulators of physical silver over the last 18 months have been sovereign wealth funds and central banks in Asia. Specifically, institutions in China, India, and the Middle East have been converting dollar reserves into hard assets. Silver is the most undervalued hard asset on the planet relative to its industrial utility. It's trading at a gold-to-silver ratio of 56.1. Historically, that ratio sits closer to 65:1 during normal market conditions. But when financial stress accelerates, that ratio compresses. During the 2011 silver rally, the ratio dropped to 32.1. During the March 2020 crash, it spiked to 125:1 before violently reversing. What we're seeing now is deliberate price suppression, ahead of a major accumulation phase. The entities crashing the paper price are not retail traders. They are institutions with multi-billion-dollar balance sheets who need to acquire physical metal at the lowest possible entry point before the breakout occurs. And they are using the COMEX futures market to create the exact conditions they need. Here's how the mechanics work. A large institution sells thousands of silver futures contracts during low liquidity hours. Typically, this happens during Asian trading hours or right before the New York market opens. The goal is not to profit from the short position. The goal is to trigger stop-loss orders and algorithmic selling from momentum traders. Once the cascade begins, price drops rapidly. Retail investors panic. Margin calls force liquidation. And while everyone is selling paper contracts, the same institution is buying physical metal in the spot market at artificially suppressed prices. This is not theory. This is documented behavior. In April 2020, JP Morgan was fined over $900 million for spoofing precious metals markets using this exact strategy. They were placing large sell orders to move the price, then canceling those orders before execution, while simultaneously buying physical metal. The fine was the largest in CFTC history, but the strategy didn't stop. It just became more sophisticated. Now here's where this gets critical for you. The amount of silver available for physical delivery on the COMEX is dropping faster than at any point in the last decade. Registered silver, which is the only category eligible for delivery against futures contracts, is now sitting at just over 77 million ounces. That sounds like a lot until you realize that open interest in COMEX silver futures represents over 890 million ounces of paper claims. That's a leverage ratio of 11:1. For every 1 ounce of physical silver in the vault, there are 11 paper contracts claiming ownership. And here's the problem. If even 10% of those contract holders demand physical delivery, the system breaks. The COMEX cannot deliver. The price discovery mechanism collapses, and spot price decouples entirely from futures price. That's the trap they're setting right now. Let me show you what's happening in the physical market. While paper price is being suppressed, premiums on physical silver coins and bars have been rising steadily since mid-January. American silver eagles are trading at $6 to $8 over spot. That's a 12 to 15% premium in some markets. Canadian maple leafs are seeing similar spreads. Even generic silver rounds, which typically trade at $1 to $2 over spot, are now showing premiums of $4 to $5. That's a 400% increase in the premium spread in less than 3 weeks. This is not normal market behavior. When premiums rise while spot price falls, it means one thing. Physical buyers do not believe the paper price. They're willing to pay significantly above the quoted COMEX price because they understand that physical silver is undervalued and undersupplied. And when that divergence widens far enough, the paper market loses all credibility. At that point, price discovery shifts entirely to the physical market. And when that happens, the repricing is not gradual. It is instantaneous and violent. Now let me show you what the banks are doing while all of this is happening. The 4 largest bullion banks hold a combined net short position of over 150 million ounces of silver on the COMEX. That's twice the size of their average short position over the last 5 years. And they are not hedging mining production. Most silver miners do not hedge. 70% of global silver production comes as a byproduct of copper, lead, and zinc mining. Those operations do not hedge silver exposure because it's not their primary revenue stream. So if the banks aren't hedging production, what are they doing? They are suppressing price to cover prior short positions and accumulate physical metal before the system resets. This is the same playbook they ran in 2020, 2011, and 2008. Every single time, the pattern is identical. Suppress paper price, accumulate physical metal, let the system break, then ride the repricing event on the long side. And here's the part that should terrify every retail investor who doesn't understand what's coming. When the short squeeze begins, it will not be a slow grind higher. It will be a gap event. Silver will open $10, $15, $20 higher overnight. Futures markets will halt trading. Spot price will decouple from COMEX entirely. And retail investors who waited for confirmation will be priced out before they can act. Because by the time the move is visible on CNBC, the entry point is gone. This is not speculation. This is pattern recognition based on every prior silver squeeze in modern history. Let me walk you through what happened in 2011. Silver started the year at $29. By late April, it had reached $49. That's a 70% gain in 16 weeks. But the move didn't happen gradually. It happened in 3 explosive bursts. Each burst was triggered by a failure to deliver event or a vault drawdown that created panic among paper short holders. The final spike from $42 to $49 happened in 9 trading days. And once the peak hit, the crash was just as violent. Silver dropped from $49 to $32 in 5 days. But here's what most people miss. The investors who understood the setup weren't trying to catch the top. They were accumulating physical metal in the 20s and holding through the volatility. And when silver eventually stabilized in the mid-30s, they were still sitting on a 50% gain. The same pattern is setting up right now, except this time the fundamentals are exponentially more bullish. Industrial demand in 2011 was a fraction of what it is today. Solar wasn't a significant factor. Electric vehicles weren't mainstream. 5G infrastructure didn't exist. Silver was primarily a monetary metal. Today, it is the most critical industrial commodity in the global energy transition, and the supply is not keeping up. Here's the data you need to understand. Global silver mine production in 2025 was approximately 822 million ounces. Total demand, including industrial investment and jewelry, was over 1.05 billion ounces. That's a 230 million ounce deficit, and that deficit is being filled by above-ground stockpiles, scrap recycling, and COMEX vault drawdowns. But those sources are finite. Scrap recycling cannot scale fast enough to meet industrial demand. Above-ground stockpiles are depleting and COMEX vaults are at critical levels. So what happens when the deficit can no longer be covered by secondary supply? Price has to rise until demand is destroyed or new supply is incentivized. But here's the problem. Industrial demand for silver is inelastic. You cannot build a solar panel without silver. You cannot manufacture an electric vehicle without silver. These are not discretionary purchases. They are required inputs for infrastructure that governments around the world have committed trillions of dollars to deploy. That means the only variable that can adjust is price, and the adjustment will not be incremental. It will be exponential. Now let me show you what's happening in the geopolitical layer that most analysts are completely ignoring. The BRICS nations, Brazil, Russia, India, China, and South Africa, along with newly admitted members like Saudi Arabia, the UAE, and Egypt, are actively working to establish a commodity-backed trade settlement system that bypasses the US dollar. Silver is one of the core commodities being discussed for inclusion in this system. Why? Because silver is universally recognized, highly liquid, industrially essential, and impossible to print. If even a fraction of global trade begins settling in commodity-backed instruments rather than dollars, the demand for physical silver will explode overnight. We're not talking about a 10 or 20% increase. We're talking about a structural shift that could absorb hundreds of millions of ounces annually, and the current supply chain cannot support that. This is the real reason central banks and sovereign wealth funds are accumulating silver right now. They are positioning ahead of a monetary reset that most retail investors don't even know is coming. And here's the final piece of the puzzle. The US government has zero strategic silver reserve, none. The Defense National Stockpile, which used to hold over 139 million ounces of silver, was completely liquidated by 2005. Today, the stockpile holds 0 ounces. Meanwhile, the Department of Defense has classified silver as a critical mineral essential to national security. Missiles, radar systems, satellites, and advanced electronics all require silver, and the United States has no domestic buffer. So what happens if a geopolitical event disrupts silver supply chains? What happens if China, which controls a significant portion of global silver refining capacity, restricts exports? What happens if industrial demand continues to surge while mine production stagnates? The answer is simple. Price spikes to a level where either demand is destroyed or emergency supply is mobilized. And given that industrial demand is inelastic and strategic reserves don't exist, the only mechanism left is price. But there's something even more dangerous happening beneath the surface that connects all of these threads. And it's the reason this crash was engineered precisely when it was. Look at what's happening in the broader commodity complex right now. Copper is breaking multi-year highs. Lithium is stabilizing after a brutal correction. Nickel is showing signs of supply stress. Rare earth elements are seeing geopolitical pressure on supply chains. These are all inputs for the same industrial revolution that's driving silver demand. And yet, silver, the one metal with the most acute supply deficit and the broadest industrial utility, just got crushed. That doesn't happen by accident. When every other critical commodity is rising or stabilizing and the one with the worst fundamentals is falling, you're watching deliberate intervention. And the intervention isn't coming from retail traders or even large speculators. It's coming from entities that need to acquire massive positions before the system reprices. Here's what they know that most investors don't. The global energy transition is not optional. It is mandated by law in most developed economies. The European Union has committed to carbon neutrality by 2050. The United States has committed to 50% emissions reduction by 2030. China has committed to peak emissions by 2030 and carbon neutrality by 2060. These are not aspirational goals. These are legal frameworks with enforcement mechanisms, and every single one of these targets requires exponentially more silver than is currently being produced. Let me give you the numbers. A single utility-scale solar farm requires approximately 350 metric tons of silver. That's over 11 million ounces. The International Energy Agency projects that solar capacity will need to triple by 2030 to meet global climate targets. That's an additional 600 gigawatt of solar capacity per year. Each gigawatt requires approximately 30 metric tons of silver. Do the math. That's 18,000 metric tons of silver annually just for new solar installations. That's over 578 million ounces per year. Now add electric vehicles. A single electric vehicle contains approximately 1 ounce of silver and electrical contacts, circuit boards, and charging infrastructure. Global EV sales in 2025 were approximately 14 million units. That number is projected to reach 40 million units by 2030. That's an additional 26 million ounces of annual demand just from the increase in EV production. Now add 5G infrastructure. Every 5G base station requires approximately 3 times more silver than a 4G station due to higher frequency requirements and more complex circuitry. There are currently over 5 million 5G base stations globally. That number is projected to exceed 15 million by 2030. That's millions of additional ounces of annual demand. Now add artificial intelligence and data centers. AI chips require significantly more silver than traditional processors due to higher power density and thermal management requirements. The AI boom is driving unprecedented demand for high-performance computing infrastructure, and every single chip, every server, every cooling system requires silver. When you add all of this up, you get a structural demand surge that is mathematically impossible to satisfy with current production levels. And here's the critical insight. This demand is not price sensitive in the short term. Governments have already committed the capital. Infrastructure projects are already funded. Supply chains are already locked in. The silver must be acquired regardless of price. The only question is when the repricing occurs, and the entities engineering this crash know that the repricing is coming. They are simply trying to accumulate as much physical metal as possible before it happens. Now let me show you what's happening on the supply side. That makes this situation even more critical. Primary silver mine production, meaning silver extracted specifically for silver rather than as a byproduct, has been declining for over a decade. The majority of new silver supply comes from polymetallic mines, where silver is a secondary product. When base metal prices fall, these mines cut production. And when they cut production, silver supply contracts even if silver price is rising. This creates a supply-response paradox. In a normal commodity market, rising price incentivizes new production. But in silver, rising price alone cannot incentivize new primary production because the economics of pure silver mining are marginal at best. Most silver deposits are too low grade to justify standalone development. They only become viable when developed alongside copper, lead, zinc, or gold. That means silver supply is structurally constrained by the economics of other metals. And right now, base metal production is facing its own set of challenges. Environmental regulations are making new mine development more expensive and time-consuming. Permitting timelines have extended from 5 years to over 10 years in most jurisdictions. Capital costs for new projects have doubled in the last decade, and/or grades are declining across the board. The result is a supply side that cannot respond to demand increases in any meaningful time frame, even if silver prices double or triple. New production will not come online for years. And in the meantime, demand continues to grow at an accelerating rate. This is the supply-demand mismatch that the institutions accumulating silver right now understand perfectly. But there's another layer to this that most analysts are missing entirely, and it has to do with the changing structure of the silver market itself. For decades, the silver market was dominated by investment demand. Silver was primarily a store of value, a hedge against inflation, a monetary metal. Industrial demand existed, but it was secondary. That dynamic has completely reversed. Industrial demand now represents over 60% of total silver demand. That percentage is growing every year. Why does this matter? Because industrial demand behaves fundamentally differently than investment demand. Investment demand is discretionary and price sensitive. When silver gets expensive, investors can choose to buy less or wait for a pullback. But industrial demand is non-discretionary and price insensitive in the short term. If you're building a solar panel, you cannot substitute silver with another material. If you're manufacturing an electric vehicle, you cannot eliminate silver from the design. The product simply does not function without it. The shift from investment-dominated to industrial-dominated demand fundamentally changes the price discovery mechanism. In an investment-dominated market, price suppression works because investors can be scared out of positions. But in an industrial-dominated market, price suppression creates a supply crisis because industrial users cannot reduce consumption. And that's exactly what's happening right now. The paper market is being used to suppress price. But industrial buyers are not reducing their purchases. They are continuing to acquire physical metal at artificially low prices, while the institutions engineering the suppression are accumulating alongside them. And when the physical supply runs out, which it will, the paper price becomes irrelevant. Physical buyers will pay whatever price is necessary to secure supply. And at that point, the disconnect between paper price and physical price becomes so extreme that the entire futures market loses credibility. We saw this exact dynamic play out in nickel. In March 2022, the London Metal Exchange had to halt nickel trading and cancel billions of dollars in trades because physical supply disappeared while paper contracts continued to trade. The LME price and the physical price decoupled by over 100% in a matter of hours. And when trading resumed, the entire market structure had changed. Silver is heading toward the same breaking point. The only question is when. Now let me show you what the smart money is doing while all of this is unfolding. Sovereign wealth funds and central banks have been net buyers of physical silver for 18 consecutive months. They are not buying silver ETFs. They are not buying mining stocks. They are buying physical bars and taking delivery into allocated storage. This is the same accumulation pattern we saw in gold from 2010 to 2012 before gold went from $1,200 to $1,900. But the silver accumulation is happening at a much faster pace because the available supply is so much smaller. The entire global silver market is worth approximately $85 billion at current prices. That's less than the market cap of a single large tech company. A sovereign wealth fund with $500 billion in assets under management could buy 5% of the entire global silver market with just $25 billion. That's a rounding error for some of these institutions, and they are doing exactly that. Not publicly, not through ETFs, but through private transactions, vault transfers, and over-the-counter purchases that never show up in exchange data. The evidence is in the vault movements. COMEX registered silver has declined by over 30% in the last 9 months. LBMA silver holdings have declined by over 15%. And at the same time, allocated silver storage in Singapore, Hong Kong, and Dubai has increased by over 20%. The metal is moving from Western vaults to Eastern vaults, from exchange-traded inventory to privately held allocation, from paper claims to physical possession. This is not a bear market. This is a wealth transfer. And it's happening right now. While retail investors are being shaken out by price volatility, here's what you need to understand about the timeline. The entities accumulating silver right now are not trying to time a short-term trade. They are positioning for a multi-year structural repricing. They understand that the supply-demand imbalance is not a temporary condition. It is a permanent feature of the new industrial landscape, and they are acquiring physical metal at prices that will look absurdly cheap in 2 to 3 years. But they need time to accumulate, and they need price to stay suppressed long enough to build their positions. That's why the crash happened. Now, that's why it happened on low volume during a period when most institutional traders are focused on other markets. And that's why it will likely continue for another few weeks or months until the accumulation phase is complete. But here's the critical insight. The accumulation phase does not last forever. At some point, the institutions that have been suppressing price will flip to the long side. And when that happens, the move will be violent and unstoppable. How do you know when that flip is coming? You watch the physical market. When premiums start spiking above 10%, when delivery delays extend beyond normal time frames, when major dealers start limiting purchases or raising minimum order sizes, these are the signals that physical supply is becoming critically tight. And when physical supply gets tight enough, the paper market breaks. We are not there yet, but we are getting close. Here's what you need to do right now. If you don't own physical silver, this pullback is your entry point. Not because price can't go lower, it absolutely can. The institutions engineering this move have the capital to push price down another $5 or $10 if they need more time to accumulate. But the risk-reward ratio at $83 is asymmetrically skewed to the upside. If you're wrong and silver drops to $70, you lose 15%. If you're right and silver reprices to $150 over the next 18 to 24 months, you gain 80%. And if a true supply crisis emerges and silver breaks $200, you double or triple your position. But here's the critical part. You must own physical metal, not ETFs, not mining stocks, not futures contracts, physical silver in your possession, or an allocated storage that you control. Why? Because when the paper market breaks, and it will break, ETF shares may not be redeemable for physical metal. Mining stocks will be subject to political risk, operational risk, and equity market volatility. Futures contracts will be cash settled at prices that have no relationship to physical reality. And the only thing that will have value in a supply crisis is the physical metal itself. And the only way to guarantee you have that metal is to take delivery and store it securely. Here's the practical framework. Start with sovereign coins, American Silver Eagles, Canadian Maple Leafs, Austrian Philharmonics. These have the highest liquidity and recognition globally. They trade at higher premiums than generic rounds or bars, but that premium is worth it for the security and resale flexibility. If you're buying larger quantities, consider bars from recognized refiners, PAMP, Valcami, Royal Canadian Mint, Perth Mint. These carry lower premiums than coins, but still have strong secondary market demand. Avoid collectible or numismatic silver unless you are an expert in that market. The premiums are too high and the resale market is too narrow. Store your metal securely. If you're holding at home, use a quality safe bolted to the structure of your house. If you're holding larger quantities, consider allocated vault storage through a reputable provider. Allocated means the metal is owned by you and segregated from the storage provider's assets. This is critical for legal protection. Do not use unallocated storage. Unallocated means you own a claim on metal that is pulled with other customers' metal. In a crisis, unallocated claims may not be honored. And most importantly, do not overlever. This is not a trade you want to be forced out of due to margin calls or liquidity pressure. The institutions crashing the price right now are hoping that leverage buyers will panic and sell. Don't give them that opportunity. Buy what you can afford to hold for 2 to 3 years because that's the time frame in which this repricing will likely occur. The entities crashing price right now are not trying to destroy the silver market. They are trying to accumulate before the breakout, and they are using your fear and confusion to buy at the lowest possible price. Don't give them that opportunity. This is the setup. The inventory is draining, the premiums are rising, the fundamentals are undeniable. Industrial demand is accelerating, supply is constrained, sovereign buyers are accumulating, And the people who understand what's happening are buying while everyone else is panicking. The question is not whether silver is going higher. The question is whether you'll be positioned before it. And the people who orchestrated this move aren't trying to exit the market. They're trying to get in before the real breakout begins. Let me show you the evidence. On January 30th, 2026, the COMEX reported a massive one-day withdrawal of physical silver from registered vaults. Over 3 million ounces pulled in a single day. That's not profit-taking. That's panic buying disguised as vault transfers. Because when price drops and physical disappears at the same time, that tells you one thing. The paper market and the physical market are no longer aligned. Someone is using paper contracts to suppress price while simultaneously accumulating metal. And that divergence is about to create the most violent short squeeze we've ever seen. Here's why this matters. Right now, the COMEX silver inventory has been declining for 9 consecutive months. We're sitting at the lowest registered silver level since 2016. That's 10 years of drawdown.